Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform, and then analyse why advisors and clients might be buying right now. This week, 8th on the list for actively run funds is Kames Capital's Ethical Cautious Fund. Launched in 2007, the fund's mandate is to generate a combination of income and long-term capital growth for clients, and it seeks to do this by deploying capital across UK equities, bonds and cash. The maximum weighting towards stocks is 60% at any one time, and all holdings must meet the fund's predefined ethical criteria. Fund managers Audrey Ryan and Ian Buckle run just under £500 million in assets between them at the moment, and they control a very diversified portfolio. The top 10 holdings represent just 15% of the fund, which has got 70 stock and 151 bond holdings according to the latest fact sheet. Now, all picks again must meet those predefined ethical screens, and Kames actually runs what it calls a strict dark green screen. So the Ethical Cautious Managed Collective does not invest in companies that provide animal testing services, weapons, nuclear power, genetic engineering, gambling services, alcohol, tobacco, pornography, certain pesticides and chemicals. They also avoid corporate or international banks with exposure to corporate or third world debt, political donors, and firms that hail from countries with poor human rights records. Kames also places great store on ESG, environmental, social and governance issues, in the belief responsible companies can glean greater efficiencies and advantages from upholding high ESG standards, and also that the opposite applies, where operational and financial performance suffers owing to the payment of fines, compensation and damages. Now, the top 5 holdings in the fund equity-wise are all familiar: Vodafone, publisher Relx, Prudential, WPP and ITV. By sector, consumer cyclicals and financials dominate, with technology, and the dark green screen limits exposure to areas like energy, basic materials and mining. Now, the next graphic illustrates how the fixed income portion of the portfolio breaks down. Corporate bonds and cash dominate. There's only minimal exposure to government paper, which may be hardly surprising given how negative yields characterise an ever-growing portion of the sovereign debt market. The ongoing charge figure is 0.79%, while the 12-month yield is 2.3%. There are income and accumulation units, and for the income ones, dividends are paid quarterly. So those are the mechanics of the fund. The next question is, why would advisors and clients be buying now, especially as the fund has got off to a bit of a slow start this year? 2 possible reasons spring to mind. First, its ethical mandate will appeal to many clients, especially at a time when corporate malfeasance remains an issue of concern and outright irritation to regulators, investors and consumers alike. The banks, for example, may whinge about tight regulation, but they have brought the fines and additional scrutiny upon themselves to the detriment of their reputation and earnings power. Second, the cautious nature of the fund may appeal to those clients who are nervous after a volatile first quarter for financial markets. The bond and cash weightings could provide ballast in the event of further upset, and the current portfolio mix is shown here by this graphic, with equities are way below the 60% maximum. The yield may not be a knockout at 2.3%, but at least again the fixed income portion underpins it. As a final point, note that the 3-year beta of the fund is just 0.81, which again may reassure those clients who have a nervous disposition. Thank you for watching, and I look forward to seeing you next time.